Well, good morning, Moritz.
Morning.
And hi, Ben, behind the camera, by the way, as well. We're here in Sydney this morning. And by the way, we've been in Sydney for a couple of days. We're in Australia, in fact, for almost 2 weeks. Love being back. Always love coming back to Australia. And specifically today, we're here because we had a great event last night together with Jerry Parker, with Adam and Richard from ECCM and the Aussie Turtles at Bebo's Wine Bar here in Sydney, hosting about 60 people, speaking about all things trend following, I think.
Yeah, had a great event. It was a lot of fun. We met a lot of people, talked everything from traditional trend following, commodity markets, crypto markets, all of it. So it was great meeting people, and today we're at the harbor. We're just here kind of enjoying the view and giving you a little bit of a presentation about what we do and what it is that sets us apart.
With unusual cool weather for Sydney this time of the year, I must say. But maybe reflecting on last night, I mean, some of the key takeaways, if we want to think about this, is the psychology of trading and how difficult it is to actually follow trends and be a trend following trader, because it feels so unnatural to have these 60 to 65, maybe even 70% losing trades. So most of the time, we're actually wrong rather than right. We have to be very professional losers, keep these losing trades very small, obviously, and then go for the big outlier trades every once in a while as they come along. But that is the tough part, right? You essentially get the feedback from the market that what you're doing is the wrong thing. And we just learned over time to cope with that, accept that, and have these excursions every once in a while into the positive tail territory where we're making a lot of money and we're just hanging on to these trends way beyond the point where most discretionary traders would feel comfortable holding them. Hundreds and hundreds of days we've been long orange juice, long cocoa. We've lost money on cocoa for, 20 years. And it's kind of feels like the first time that we're getting some payback on it. But we're holding this trade for hundreds of days and hopefully hundreds of days more.
Right. Exactly. I was just mentioning we are trading a lot of markets, and in hunting outlier trades, it makes sense to do that on many markets that are preferably uncorrelated, right? So we want markets which are really non-traditional in the sense that they are not traded by everyone. They give us the opportunity to take these outlier trades, to hunt for them. Think of kind of white maize in South Africa, for example. One of the classic examples people don't think about as a market. Then there's, of course, the traditional commodity markets in energies. There's cotton, there's wheat, all of that. We are always looking for new markets as well. So it's not limited to the ones we're already trading, but really we are also hunting for new markets that we can include into the portfolio. And well, that's what we do, right?
Yeah, and look, I mean, the more uncorrelated they are, or the more independent they are, the better it obviously is. But we're not shying away from markets that have relatively structurally positive correlation as well. Like think about London cocoa and New York cocoa, or milling wheat and Kansas wheat and Chicago wheat. I mean, all of these markets are essentially tied to the hip, but every once in a while they're not. And milling wheat dislocates from Kansas wheat, as it did, for instance, last year with the Ukraine conflict. So you just don't know which market it's going to be, and that's why you have to take every trade and trade all of these markets, because every once in a while one of them gives you this big outlier move that we just need to pay for all these inconvenient losing trades, small losing trades that I was mentioning before.
But it's not the only thing we do, right? So this is a classical trend following system that we are doing, where I would say not a lot of people do it that way, because most people kind of like to have smoother return streams. And the other thing we do is actually spread commodities and trend following in commodity spreads, which sets us apart and adds a lot of diversification to the overall system, actually.
Actually, before we go there, we should speak about the spreads, about the classic trend following. We're kind of like in this small group of like-minded people here together with Jerry, maybe a Paul Mulvaney. There's like a handful of other people. We jokingly say we're the last, they call us sometimes the caveman or whatever. People standing doing it that way. We shy away from, dynamic position sizing or vol control trades, or essentially playing around with position adjustment trades once the trade has been initiated. It doesn't make a lot of sense to us. I mean, it does cost commission, it does cost bid offer. It's not for free, and we think that once you have that position, if that position starts performing and it, because of that good performance, develops a, larger footprint in the portfolio, it starts to move the needle. If you rebalance that trade and dynamically adjusted the position size, you're essentially executing a mean reverting profit-taking trade, which has nothing to do. It's the opposite of trend following. So we really don't like that. We'd rather accept the volatility. We don't see volatility as a penalty. It's more like a inconvenience fee that comes along, which we have to accept and absorb and work with in order to make, you know, the big money. We do want to make big returns. We're not here to make 7-8% a year. We want to make 15 to 25 or something like that per year. So we have to work with volatility. It is the natural byproduct of that trading process that we follow, right?
Yeah, it is, exactly. And it's not risk per se, right? Volatility is often set as equal to risk, but volatility is actually something which gives the markets breadth. So it's not only to the downside, it's also to the upside. And that benefits you a lot if you kind of like cut the losers short and let the winners run.
Risk is done through position sizing, or risk is managed primarily at the beginning, at trade inception, through appropriate position sizing. And we size every position essentially in the same way. That doesn't mean that we're trading the same number of contracts for every market, but we're risking the same amount of closed equity or core capital for every bet that we're taking. And then we're doing it over and over and over again on all these many different markets. And most of the time, as I've said, it results in a small loss, or kind of like a, you know, zero trade, nothing happens. Every once in a while you have these big moves.
Exactly.
Now you mentioned the things in the calendar spread markets, and that's one of the probably things I have in my history as a trader. Is I was trading a lot of commodity spreads, calendar spreads. I put a lot of effort into figuring out these synthetic markets, just creating cross-market spreads, even things as lumber versus gold, or you take the ratio of one market versus another, or you take the DAX index minus crude oil. I just never got that to work. I don't know, maybe that's because of my research not being good enough, but I couldn't get it to a point where I'm satisfied with the trade statistics or the resiliency, which, by the way, is very important, is the robustness of that trading system that you're developing. It has to have sample size, it has to have a good solid foundation without too many parameters. The simple stuff has to work. If you make it too fancy and too complex, you're on the wrong track. So we went back to the commodity calendar spreads, and what you see there is that the entire forward curve or futures curve, when you take all these possible spread permutations along it, they do have different momentum behavior at different points in time. So take crude oil, for example, which has monthly expiries. You can create all sorts of permutations of spreads, the first minus the second contract, or the 7th minus the 10th, or the 5th minus the 13th. All of these are liquid. And what you find is that further down the futures curve, the trending behavior is way different and also more consistent than at the front of the curve, where obviously a lot of stuff is happening. The market is very reactive to whatever is happening in the world right now. Israel, Hamas, that conflict is moving the crude oil market, right? So that spread at the front is also much more volatile. It's very punchy. And that is because at some point, physics take over. It is a physical commodity, and the closer you get to first notice or last trade, the less you need to forecast anything. You know, it's a question of, it's a contractual obligation that you have to either make delivery or take delivery of crude oil in Oklahoma at the price that is valid at that point in time. There's no longer any need to forecast storage or interest rates into deck 24 or deck 25. So this part of the futures curve further down the tracks is driven by different dynamics, and we found that exploiting momentum in all these markets, not just crude oil, but also nat gas and the grains and the softs and some of the metal markets, there is an edge for us to be had. And it's so nice to put that stuff together with the single market system that we trade, because they're uncorrelated. So we have two systems, both with positive return expectancy on a standalone basis. We also offer them on a standalone basis. And our fund, we combine them. All right, so most of what we do, and as we've said, we're systematic traders, so we have essentially that engine room that runs all the time based on rules. We follow these rules. There's about 5% of our trading activity that is options linked. That is discretionary, and maybe you want to speak about that.
Exactly, like you said, 5% of what we do is discretionary option overlay. What we do there is actually we use options to enhance our return profile, replacing part of the delta from futures, if it's convenient, with an option far out on the curve, for example, which gives us additional convexity in the trade. So we are replacing part of the delta with an option, and this adds to both the downside and the upside. So we have limited downside in case of the option compared to the future, and we get convexity on the upside actually if we really hit the ball out of the park.
So Moritz, you were speaking about these delta replacement trades and the option trades that we do. It's important to understand 95% of our trading is systematic. There's this engine room that runs all the time, which is great for us. We love being guided by these rules. And then occasionally, actually very rarely I should say, we execute these delta replacement trades. It's occasional because these trades aren't available to us in all the markets that we trade. We trade 90 markets. There's probably 10, 15 or so markets where we can really execute these options-based trades in a meaningful way. What we're looking for is to amplify our exposure to a possible but never guaranteed outlier price move. And we like doing these trades on markets where we have big open trade profits. So never without an underlying position on the systematic portfolio. There always needs to be a reference point. But when we sit on these profits, we'd like to really just go for more convexity, transforming a linear futures exposure into a non-linear, positively convex options-based exposure, partially, never fully. And we like to do that long dated, so where there's not a lot of gamma, not a lot of theta, where we have a lot of essentially convexity at that point in time. It's less about the implied volatility exposure, it's really more about optionality. Let me give an example, because we did speak about the crude oil futures, and that's actually one of the markets where we've executed that trade recently. We're long crude, we're long essentially the entire petroleum complex, from gas oil, heating oil, gasoline, Brent, everything really. And we might be short or out of crude at some point. It's been going down yesterday, but still we are sitting on these profits, and the curve had changed from contango into backwardation, and we found a way to take some of these long positions, long futures positions that we had off partially, and replace it with long call options for the same delta. But now things have changed. You know, it's now no longer entirely linear. It's linear plus that non-linear option exposure.
Yeah, and it's adding some spice to the whole complex of systems we are trading. Let's maybe summarize what sets us apart, because I think it's unique. It's something new. It's something we like to do. And yeah, it's trend, spreads, and a little bit of discretionary options overlay.
And the options fit our background. You are the PhD quant. I have an options trading background. We find it very tough to systematize that. I wouldn't really systematize it. It's too multidimensional. There's too many options, Europeans, Americans. Sometimes the liquidity changes between one and the other. Certain strikes are liquid, others are not. We want to be very picky about these trades. We'd like the market to really come to us. We're working with limits. We not have these orders really resting in the order book. If they don't get filled, they don't get filled. But we really want this to add money to our trading process all the time. And we also label these trades, every single one of them, as a non-systematic discretionary options trade, because we need to be honest to ourselves, our investors, at the end of the day, at the end of every month, every quarter, every year, did that stuff actually make money? Has it meaningfully changed our performance profile? And if it doesn't, then at some point we need to stop doing it. But so far we've always made money with it, not necessarily every quarter, but surely every year. And even though it's not like, you know, it does make you 10%, it may make you 20 basis points in the month, sometimes 100 basis points in the month, it may lose 15 basis points in the month, but over time that stuff compounds, and that is very important for us. We're starting this business, we're not claiming to be, you know, better than really everybody else, but clearly we need to, you know, set ourselves apart with things that make sense, that are not made up, that are not based on a, you know, crazy narrative, but it's grounded in, you know, data, it's grounded in rules, and that hopefully will allow us to outperform and produce really good and meaningful returns for ourselves and our clients.
And that's what we are setting out to. Like, we want to produce absolute returns. We don't want to produce the highest Sharpe ratio. That's not what we do. It's not kind of the way trend following in general works. We're aiming for absolute returns for ourselves and our clients.
You don't win this game by having the highest Sharpe ratio, I think. No. You can't eat that Sharpe ratio. You can buy lunch with your bank account from these profits that we make. That's it. I hope you liked it.
Thank you.